In this video, we are going to talk about financial models and how they can be used for financial planning. So financial planning, these are the ingredients, the key ones at least, there's more to it, but these are the basic ones, the fundamental ones. Sales forecast. Many cash flows in a company, and cash flow is keen in finance, depend directly on the level of sales, and is often estimated by sales growth rate. So as sales go up, hopefully, cash should go up, and vice versa. If sales go down, then you should expect a decrease in cash flows. Pro forma statements, setting up the plan as projected financial statements allows for consistency and ease of interpretation. In other words, with this sales forecast, you can go ahead and then generate estimates of what your financial statements are going to look like in the future, in upcoming cycles, 3 months from now, 6 months from now, a year from now, it depends. Asset requirements. Well, if your sales are predicted to go up and they're going to be sustainable, then you may need to expand your assets. If you're a manufacturing company, the more products you sell, the more you have to produce, meaning that you may have to expand then your inventory or expand your machinery and so forth. Also, the opposite is true. If your sales forecast is going to be a decrease, then you might want to think about contracting your assets. Financial requirements. Well, if you're going to get these assets, if you're going to get more assets, then you need to decide where's the money going to come from, internal funds, or is it going to come from borrowing money or selling more equity? Then we have the plug variable, determined by management decisions about what type of financings will be used. That's related to what just mentioned. Should you get it through debt, through internal funds, through more equity? Capital structure is key to this step, this piece. And some economic assumptions, explicit assumptions about the coming economic environment, which is used also primarily to extract the sales forecast. So if you want to build these pro forma financial statements, how should you develop that future unknown income statement, which also would affect that future unknown balance sheet? So we have this thing called percentage of sales approach, meaning that in the most basic example form to understand the concept, if sales is going to grow up by 10% and all your costs relative to sales are steady or consistent, then your cost should also increase by 10%. But it's important to understand that not every line item in the income statement can be directly related to sales, like depreciation may not. So here what we have is a couple bullets, giving you a few examples. Costs may vary directly with sales. If this is the case and the profit margin is constant, that's the example that I mentioned, that if sales go up by 10% and your costs are directly linked to sales, the variation, then it'll go by 10%. Your profit margin stays the same, but you're still making more money. It's just that the margin stays the same. However, depreciation and interest expense may not vary directly with sales. Those are functions of your debt levels and the type of debt you choose to go with. Depreciation depends on your assets and the life of the asset. So when those come in play, that's going to change your profit margin. Let's say your sales go up and your costs go up accordingly, but your depreciation and interest stay the same, then your profit margin may go up. Dividends are a management decision and generally do not vary directly with sales. This affects retained earnings. So dividends come in play after the income statement is built, because now you have a net income and then the company decides if they're going to pay out dividends or retain all the income that came in the company. However, that is not decided by sales level Could they guide themselves based on sales, saying if we have certain sales, this, if we have certain level of sales, we should then pay a certain amount of dividends? That could be a policy, but it's not necessarily. So it's not really directly. It's typically a decision based on future expectation of cash flows. So these affect retained earnings, your balance sheet, but not necessarily the income statement, or it's not necessarily going to change the same way sales is changing. A little more about the percentage of sales approach. Now we're talking about the balance sheet. So there are some assumptions you can put in place when building these financial statements in order to simplify the process at the beginning. We're not going to discuss the following thing I'm going to say in this chapter, but then a sensitivity analysis and scenario analysis can be applied where we do change other things and make it more complex to see where things may go. But for that initial fundamental basic first set, in order to see what could happen, what's going on, you initially can assume that all assets, including fixed, vary directly with sales. So if the sales grow up by a certain percentage, then you need to increase your assets by that percentage as well in order to support those sales. Just like anything, if all of a sudden there's an increase in demand for your product and you're selling more, then you have to buy more materials, more capacity on your production line, etc. Accounts payable also normally vary directly with sales. If you are maintaining the same policy and accounts payable, those amounts in accounts payable are mainly representing your suppliers, the payments to your suppliers. And if you do wages payable, you have to throw that in there too. The more employees you have to grow your workforce by the same percentage to support sales, then sure, a lot of accounts payable will be directed to sales. Notes payable, long-term debt, and equity generally do not vary with sales because it depends on management decisions about capital structure. This ties into what we said in the previous slide, where interest payments and a dividend policy, which affects retained earnings, are not decisions that are made based on level of sales. The change in the retained earnings portion of equity will come from the dividend decision. This is tied to what we spoke about on this one. So these two are tied together. One is talking about debt, and the other one is talking about the retained earnings, like we said about the dividend decision. External financing needed. More on that on the next couple of slides, but in a nutshell, the easiest way to talk about external financing needed. Let's say your sales are growing, so you need to grow your assets. You need more assets to support that new level of sales. You could use what we call internal funding. That's cash inside the company, equity, retained earnings inside the company. So money that's inside the company already can be used to support the growth in sales by using that money to buy the assets you need for that increase in sales. However, let's say that your sales increased by a larger amount that way you could support with the money you have in-house. Then you have to go to the financial markets to get money, get that cash. So you can do it through borrowing money or selling equity. So external financing needed is when you have to go to the financial markets and raise capital, bonds, commercial loans, or sales of more shares. So that's what they mean by external financing needed. And we'll talk about that in a moment, at what point you may need to do that. So let's say you want to do calculate your external finance needed as a dollar amount. That one you can do it by percentage of sales. Now the formula is lengthy in a way, not too bad, but it's just a couple multiplications and subtractions. But you'll scale it. Notice how some of them are divided by sales. And they have, so you have the assets divided by sales, multiplied by the change in sales. Then you subtract the spontaneous liabilities divided by sales times the change in sales. Then take away the profit margin multiplied by the projected sales for next year. It should say projected there. But then you want to multiply that by 1 minus the dividend payout ratio. 1 minus the dividend payout ratio, it's also known as a retention ratio, which is the retained earnings, how much you keep in the company versus how much you pay out. So you see 1 minus dividend payout ratio, it also known as the retention ratio, because either you pay dividends, or you keep the money, you retain the money. There's an example, numerical example of how that would say that. Well, you're going to need 565, let's say it's millions or whatever it is, thousands of external financing to support those change in sales. And that's why change in sales is in a couple places here, while maintaining your dividend payout policy. Okay, continue. Now, external financing and growth. You can also set some points where you'll know that if my sales are growing past this point, I may need external financing. But as long as my sales are growing below a certain level, then I can continue with my internal funds. So let's go over the slide here. At low growth levels, internal financing may exceed the required investment in assets. In other words, you may have enough in your retained earnings that you can afford to grow your assets without having to go outside the company, the financial markets, to get external financing. You can do it in-house. However, as the sales growth rate increases, the internal financing would not be enough. So if your sales are jumping a lot, you may not have enough money in the company in-house to grow your assets as required. And then you may have to go to external financing. So where are those points that we speak of? So this is how you can calculate it. So the internal growth rate tells us how much the firm can grow assets using retained earnings as the only source of financing. So how can we, or when can we get away with using in-house funds? So we start here with the return on assets. In this case, they're saying that net income is 66, could be million, thousands, whatever the number may be. And the assets are 500. So the return on assets is 0.132. Okay, we save that 0.132 as our return on assets, put it on the side. Now this thing that B, now that's not multiplication. We're just telling you what it's called, plowback ratio. Earlier, I mentioned the retention ratio. Plowback ratio is just the same thing with a different name. You may hear retention ratio used more often, but do understand that this one means the same. So the retention ratio here is, once again, the 66 is the net income at the bottom of the divisor. And what they did is they retained in the company 44 out of those 66, meaning they paid out 22 million, thousands, whatever the case may be, $22 in dividends, and they retained retention ratio 44. So the retention ratio is you take the 44, what they retained, divided by the net income, and you get that 0.6667. So now we have that number. So now let's apply the formula, the internal growth rate. Internal growth rate, what it means is the growth rate in sales that can be supported with internal funds, not having to go to external funds like debt and equity in the financial markets. more debt and selling more equity. So the formula is the return on assets multiplied by the retention ratio, or the plowback ratio, B. In this case, we're using B as the letter, the variable, divided by 1 minus the return on assets times the retention ratio. So we already had the two numbers we needed. We calculated on top of it. And once you do the mathematical magic of algebra and arithmetic, you end up with a 9.64%. This means that if your sales grow at 9.64% or less, you may continue using internal funds and continue your dividend policy, etc. So your sales growth is 9.64% or less. It can be supported in-house financing, to put it that way. Now, the sustainable growth rate, it's at what rate can you grow and be able to support the growth with internal financing and borrowing money, debt. So similar to the previous formula, but instead of return on assets, we're going to use return on equity. In this case, 66 is the net income, 250 would be the common equity. So when you divide those two, your return on equity is 0.264. We already know that the retention rate was 0.667 from the previous slide. So what's going to be called the sustainable growth rate, it's ROE multiplied by the retention ratio divided by 1 minus ROE multiplied by the retention ratio. So now after we calculate, we end up with 21.34%. So how do we interpret these two numbers? If you're between 0 and 9.64%, you can do it with in-house financing, just retain earnings. If you are between that 9.64% and 21.34%, now you can do it with internal financing, retain earnings, plus you'll need to raise capital through debt. You'll need to go external. Now, anything above 21.34%, you may have to use other source of financing like selling equity or changing your capital structure to borrow more money. Couple of details about financial planning models. Financial planning models do not indicate which financial policies are best. So it's not going to tell you this is better than that. It's just going to give you information. Models are simplifications of reality, and the world can change in unexpected ways. I mentioned earlier that this is a basic, fundamental, clean, simplistic way to do it, to get a view of what things may look like, but then you could apply sensitivity analysis and scenario analysis and change a bunch of our variables that may better reflect what the real world looks like or really may happen. Without some sort of plan, the firm might find itself adrift in a sea of change without a rudder for guidance. Meaning is that even if it's an imperfect approach, it's better than nothing. So you got to start somewhere with your planning. Then you can adjust, tweak, improve. That will be it for this video, and we will see you on the next one.